I sat for 10, 15 years reading Rich Dad, Poor Dad, thinking it was great. I need to go do this, and just sat on my butt. And when I finally went out and did it, things have changed. Now I've got more opportunities. Now I've got more knowledge. Now I can network more and say, hey, look, I started small with 16 units.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association, providing benefits and services to real estate investors and rental property owners for over 48 years. With your host, Brian Hamrick from Hamrick Investment Group.
This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com. Hello and welcome to episode 142. My guest today is Scott Pollmann, and Scott is a high school science teacher in Grand Rapids, Michigan. He also has invested in a 16-unit in Hastings, Michigan, and we're going to be talking about that 16-unit today, how he found it, how he took it down, and the challenges he's had in getting it to cash flow for him. We're also going to be talking about something that is very important to Scott, and that is mentoring, because he works with high school students. Scott, welcome to the show.
Thank you so much, Brian.
Let's start with just a little bit about how you, as a high school science teacher, came to decide, you know what, I'd like to buy a 16-unit in Hastings, Michigan. Tell us a little bit about that.
Absolutely. I started out really probably 15 years ago reading the Purple Book. And as I got into that and realized that, finance isn't everything that I was once taught, I started teaching that to students in a computer class and playing the cash flow game with them for 5, 6, 7 years with high school seniors.
Were you playing the kids version or were you playing the adult version?
Oh, no, the adult version. And even played a little bit of 202 with some of the options.
Oh, really? Okay. I've never played 202. We're talking about the Robert Kiyosaki Rich Dad cash flow game.
Yep,
board game.
Correct.
Yeah, which if you haven't played it or don't own it, it's a really good way to kind of get your mindset right when it comes to investing.
Yeah, I even had a student go out and with no money down, as it were, buy some pigs with the farmer he was working at out in Byron Center and make a little bit of money on the side with really no extra work or money input.
So he learned the whole no money down philosophy and bought some pigs with it.
Yep.
That's We should have him on the show, investing in pigs. So
from then, we took a short sabbatical and I taught up in Alaska in a small bush village up there. We ended up coming back to Grand Rapids 2.5 or so years ago, the summer of 2016. And at that time realized that we needed to actually put our money where our mouth was, as it were, and start investing in real estate.
Yeah, you're obviously, when you say we, your wife was all part of this decision with you?
Absolutely. We started with the Rich Dad coaching program and spent 18 weeks coaching and learning some of the terminology and some of the different methodologies through that program.
Okay, so you invested in a kind of a coaching mentorship program specifically about multifamily, or what was the strategy?
Usually they're talking about single families, duplexes, and it just so happens that we found a smaller 16 family and thought we'd start small.
Okay, good. You know what? Starting with 16, that's not a bad way to go. So tell us, like working with the Rich Dad coaching, did they help you go through the analysis and figuring out how you were going to be able to actually acquire this property?
Yep.
Talk about that a little bit then.
In addition to all the terminologies and strategies and loan products that are available in real estate and tax advantages, and there is I'd say a couple week session in the beginning on personal finance and getting your finances in order. You're able to call the coach whenever you need to within business hours. And I went over all the numbers with different properties with them and talked to them about the 16 unit in Hastings. And they helped me verify that, it sounded like a good deal.
So how did you find the 16 unit? How did it come across your desk?
My father-in-law and wife are totally to thank for that. They were just driving by Hastings, and like you see kind of on a regular basis on the side of the road, the signs that say "We buy ugly houses." They found this pair of buildings in Hastings that looked really ugly. There were dirt piles in the front and in the back where some project had happened years ago that had never really been taken care of. And I approached the owner. It wasn't up for sale. It wasn't on the MLS. I called the number on the sign and left a message and said, if you'd entertain the idea to sell the property, give me a call back. And it kind of all went from there.
And so he called you back, obviously.
He called me back, was a little skittish because he had somebody a year or two before that was interested in buying and apparently had some issues with financing. I assured him that wasn't going to happen, and away we went. It took a little bit longer since he wasn't fully in the mode of, I want to sell my property. I was really green and didn't know what I was doing, so it took a little bit of time and actually almost a year, but got the deal done.
Were people actually living in the 16 unit?
In theory, it was fully occupied at purchase. Find out that while the unit was occupied when I did my walkthrough, somebody decided to skip town shortly after I took ownership.
Okay, so it was physically and economically occupied, but then how many, like just one person decided to skip town, or what?
Yeah. At that time, only one person wasn't there, I think, when I took ownership. Mm-hmm. Slowly over 16 months, we've replaced about 75% of the tenants. But right now, as of today, I'm fully occupied and have already got somebody pre-approved for the unit that's going to come vacant in a couple days.
Okay, so before we go on to just like once you acquired the property, let's spend some time talking about how you took it down. You, like in your own words, you were green. The seller was probably somewhat reluctant, so there was a lot of finessing there. Was it the coaching program that you were doing that helped you figure out what to say to keep things moving, or what was it that you brought to the table over that 12-month period? Because it took you about a year to get to the close. How did you make that happen?
It probably has to do with a little bit of being aggressive and stubborn. I kept contacting him, asking him information. There was a point around Christmas when he was kind of having second thoughts, knew that the contract was signed and he was legally bound to sell me the property. But since he had his name on the property and his kids had gone there and helped him work, he was having a little bit of seller's remorse. But since there was that contract involved, I kind of knew it was of sorts a waiting game, since legally, I mean, he could have backed out, but then there would have been some recourse, I suppose, on my end.
Okay. So he was more than reluctant. He was ready to back out, but you had to kind of insist, hey, we're going to go through with this, huh?
He never said that he wanted to back out, but he said, I'm kind of dragging my feet a little bit. He was honest with me, saying, I've poured a couple years into this. My kids have helped me work on it. Their father and son name was on the building sign. So he was just, having a little bit of seller's remorse with a property that he'd put a lot of time and effort into.
So what was the condition of the property? I mean, what were you buying at the time?
It's a 1960s built brick over wood property. I'm planning at the moment that I'm going to lose some hot water heaters. The whole property is electric. And there's only so much that's really been updated. I'd say a third of the units have been, how shall I say, they've got new cabinets and maybe some new carpet. Mm-hmm. But apart from that, not a lot of updating has appeared to have happened.
So it's a little dated, a little tired.
Yeah.
Sounds like you've got some mechanical capital improvements, CapEx that you're going to have to put into the property.
And it needed a little bit of roof work when I got it. I knew that the roof was getting wore. In fact, the appraiser in February, when it was good and frozen in Michigan, got up on the roof and he's like, there's some soft spots even now that I'm kind of scared to step on.
Oh, okay.
And come to find out that the roof needed some work. It needed about 92 sheets of plywood to finish the whole project.
Okay, so you had to bring that money in, in after close to do the roof. Then.
Yep, and I'd planned for that. I knew that the roof needed to be done, and I'd gotten quotes ahead of time.
So before you closed on it, you knew what kind of money you were going to put into it right up front.
More or less, yeah. I under budgeted by a little bit, but my initial quotes had been about 30.
Yeah. You know what? No matter what you budget, you're always under budgeting.
Yeah.
Like take whatever your budget is and double it because you're always under budget.
Yeah, my contractor called me after the first day or a couple days and said, we billed you or put in the quote 30 sheets of plywood. I used those on the first half of the first building. And I went, oh, okay. And we went from there.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. So can you talk about the numbers? Like how did, just working out with the seller who, first of all, wasn't even wanting to sell, how did you negotiate a price to begin with?
Using the coaching, because I had no idea how to evaluate a property. I created an Excel spreadsheet and figured out kind of what cap rate it might go for, what the rents were at. I at least knew that information, had some of his numbers, and went from there. And then came up with a number that was quite a bit lower. So I offered him, well, I guess we started out at 500. And because of the dirt piles and the drainage tiles that needed to be completed and the roof, we negotiated down a whole 10 grand. And he's like, that's it. I can't go any lower.
So 490,000.
Yep. Was my purchase price, which is about 30,000 a unit.
30,000
in 2016.
Mm-hmm. What cap rate were you using?
My on paper offer price using a 9 cap would have been about 550.
Okay.
So I feel like I didn't do too bad. Mm-hmm. The property appraised for quite a bit more. So I feel like I've, at least in today's market, have quite a bit of equity built in.
Did you negotiate the price before you actually got in there and did your physical inspection?
Yes.
Okay. So, and then it sounds like based on because you do your physical inspection, that's where you realize, you know what, I'm going to have to put another 10, 20 grand into the roofs. Which I'd imagine that you put at least that much into the.
Ended up being about 45, but yeah.
Oh yeah, take your budget and double it, huh? So yeah, you put 45 into the roofs. Yeah, and then you got the water heaters that are limping along that you're going to have to replace it at some point. I'm sure there's some other mechanicals there that you've got your eye on, just waiting to go out. Yep. So basically, you went back to the guy and you said, "Hey, I've got all these problems. Done my physical inspection," and he can only go down $10,000.
Was only willing to.
Only willing to. Yeah. So tell me the calculation in your mind then to say, okay, for 490, it's still a good value. I'm going to go forward.
I knew that when you consider tax values or tax bills in single families, and the fact really that when a single family is empty, you're losing money on a daily basis. Going bigger and buying a 16-unit property just really made a ton of sense.
You get the economy of scale.
Even when I've got a couple units empty, I can still make all my payments. I'm still making some cash flow. Starting with a 16-unit property just made a ton of sense.
One of my first big multifamilies was a 12-unit. And I overpaid for it. It was probably like I should have doubled my budget going in, but it's such a great property. I'm so happy that I bought it. But it always takes longer and it always costs more up front to get it stabilized and get it to a point where you get to that daylight at the end of the tunnel. The first year or so, it just feels like you're going down a dark tunnel. And every time you turn around, there's more money you have to put into it, and things are costing more. But there is a light at the end of the tunnel.
That's good to know.
You're still in it now, so yeah. So we'll get into this. So, what was your strategy when you closed? Were you going to self-manage? Were you going to hire a property management company?
The coaches, and I think it's wise to say, suggest that your first property you should self-manage, so that you have an idea of what you're getting into, what's the process. You can't really truly appreciate a property manager, I don't think, until you've actually done it and then realize, oh, this is a ton of work. This is a ton of time that I can better use elsewhere. A buddy of mine, Tony, in Colorado Springs, said 16 units, you're teaching full time, you need a property manager. And my roofer's cousin, I believe, is a property manager with Excel Property Management in Grand Rapids. And he called his Phil and said, would you be willing to go to Hastings? And that was really kind of the end of the discussion, because I realized I don't have the time to manage 16 units and deal with the showings and deal with trying to find tenants and qualify the tenants and court dates and repairs, and I just don't have the time.
I kind of went through the same calculation when I bought my 12 unit. Do I want to manage it? And for about 30 seconds, I thought, yeah, maybe I will. And then I said, you know what? I don't want to deal with tenants. I don't want to talk to them. I don't want to evict them. I don't want to go to court or any of that. So, yeah, I'm on the same page with you. So you found a professional third-party management company. Going in, what were some of the immediate challenges you faced once you acquired the property?
Making sure I've got enough cash at the end of the month. Went all in, and whether that was a great idea or whether I should have found a partner, it's kind of water under the bridge at this point. I don't really have a choice because I'm all in. But making sure I don't want to use any of my personal money or any more of my personal money to fund the project. I want to make sure that the investment's taking care of itself.
Yeah, the cash flow is paying for the improvements.
And so far, things are going great. We used some of our own personal money and lent the business money for the roof. But apart from that, cash flow is really the primary challenge, making sure that everything's fixed and running properly.
If you are thinking of leaving your W-2 job and becoming a full-time real estate investor, one of the greatest costs you must consider is healthcare for you and your family. When I made this transition 5 years ago, I found the whole healthcare insurance process to be confusing and frustrating. That's why I'm glad I met Chad Creasy at RCB & Associates. Chad is a professional health insurance agent who helps real estate investors and small business owners understand and choose their best healthcare options. And best of all, his services are covered by the insurance company and won't cost you a dime. If you're expecting a change in your healthcare insurance coverage for any reason, then you owe it to yourself to contact Chad Creasy at rcbAssociatesLLC.com.
And tenant-wise, were your tenants what you thought they were? I mean, you've in 16 months, I think you said, you've turned over 75% of the units.
About, yeah.
Which is a little more than typical, but I guess when you take over a property, that's probably a little tired, a little dated, being self-managed by a mom and pop type manager. The tenants, you can probably expect that most of them are going to move out. Within a year, you're probably going to get at least 50% turnover. Tell me about that.
I think for the most part, everything was normal. There were some drug issues that I've heard from law enforcement in the area, in the unit that was, I don't think, ever filled. I don't think I ever got a payment from him anyway. There was a tenant that was, I would say, continually requesting law enforcement to drop by the property, and she ended up going. But then it's kind of normal, hey, we bought a house, we're going to move because they're tenants and they're living in apartments, and that's going to happen.
So life circumstances.
Yeah.
It was. So were you raising rents? Like what was your philosophy on going in and getting those rents up?
I still think the rents are a little low.
Where are the rents right now?
It's $675 for a 2-bedroom and $125 for a 1-bedroom.
Wait, how much for one?
I'm sorry, $625.
625. Yeah,
Yeah.
I'll move into your place for $125 a month. So $625 for one, $675 for a 2-bedroom. Who's paying the utilities?
Tenants are paying electric, and the units are all electric. So electric heat in the winter is a little costly.
So they probably have some high electric bills.
Yep. Some.
Yeah.
I mean, comparing it to my own personal residence, it's fairly reasonable, I think. I don't think it's outrageous. But they do have an electric bill built in.
So your gas cost is really just to heat the hot water?
I don't have any gas. It's all electric.
So the entire building's electric,
Yep.
no gas whatsoever?
Yep. Electric washers, dryers. I've got 2 coin op in each building. The whole building's electric.
Okay.
So that being said, if you factor in, I know there's some 2-bedrooms right in town that are about $900, but utilities are included. So thinking about the winter rates, I'm assuming I'm about $25 low, maybe. We did try to raise them when I first took ownership, thinking, oh yeah, I can raise the rents, no problem. Rents in Grand Rapids are crazy high. Maybe I can get a little bit more in Hastings. And when they sat empty for a little bit longer than I would have liked, decided to put them back at $675, and they fill right away at that price.
The elasticity of pricing.
Yep.
You test a little higher, see how long it takes to fill. If it takes too long, you bring it down, and then the market tells you. Were your numbers dependent on getting that upside in the rent?
No, not at all. Not at all.
So you ran your numbers as if the rents were going to stay right where they are. Okay. So you're not missing your projections or anything.
Nope. Things can only, in my estimation, go up from here.
How is the rental market in Hastings?
When they're marketed correctly, units fill within a week or so. There is a housing shortage in Hastings and Middleville, just like there is in Grand Rapids and the greater area.
Okay. Because Hastings, Middleville, they're on the outskirts of the Grand Rapids area, smaller communities, more rural type communities. But there's still the housing shortage and still the demand for housing in there as well.
Absolutely. And the awesome thing I think about Hastings is that it's kind of a pocket community for Battle Creek and Kalamazoo, some Ionia, and Grand Rapids.
Yeah, you could live there and commute to Battle Creek, Kalamazoo, Grand Rapids. So it is a good kind of like in between. Yeah. It's called Middleville for a reason.
Yeah, well, and
it's in the middle of everything.
And Hastings is constantly doing community events. They've got a jazz festival in May, I think it is, that attract people from all over the greater Hastings area, I guess I'll call it. They're having a farmer's market 2 days a week that are doing different family events. I almost want to say every other weekend.
So it sounds like from an income perspective, you've been hitting your targets.
I think so, yeah.
So from the expense perspective, tell me about that. Are you spending more money than you had anticipated?
I don't think things are unusual, no. At the end of the month, my replacement reserves that I'm trying to build up are continuing to get bigger and bigger every month.
So you're building so talk about that. You're building your replacement reserves. That's an important thing because, first of all, explain what that is and how much you're putting into that each month.
Well, right now I'm putting 100% into replacement reserves. That's not currently going out as expenses.
So you're not taking the cash flow and putting it in your pocket and going to Disney World? No,
that would be beautiful, and might happen with the next property. When we bought the property, we pulled out $130,000 HELOC on our primary residence, which I'd love to get paid off as quickly as I can.
So you pulled that out in order to be able to put down the equity?
That was down payment and part of roof. The remainder of the money, I was able to pull out of my Roth IRA. When you have money into a Roth IRA for more than 5 years, you can pull out the principal and leave any gains. So we pulled money out of the Roth IRA to help finish the roof and any other legal expenses and closing costs. Well, no, actually not closing costs. With the purchase of the property, which means right now in hindsight, I should have had some replacement reserves to cover any other expenses that needed to happen.
Going in,
even being a turnover.
Going in, you should have had a little bit more cushion to cover those unanticipated expenses.
Yeah, absolutely. So right now, when I ran my numbers as I'm going to dump $12,000 a year into replacement reserves to build them up because I don't have any cushion. And that's not really a wise thing.
So you're taking about $1,000 a month and putting it into your replacement reserves, which is just a checking account in the bank?
At the moment, yeah.
At what point with 16 units do you feel that you'll have filled that replacement reserve where you can start putting that money in your pocket?
I think, since I met you a couple months ago, and I've been burning through your podcasts as quickly as I can, guys on the podcast are saying, you should have 3 to 6 months worth of payments. So when I've got about 30 grand saved up, I'll feel comfortable to either use some of it for capital improvements or pay down debt.
Right. So your mortgage payments, I'd imagine, are probably around $4,000 or $5,000 a month.
Yeah.
Yeah, that's typical on that type of loan. Plus, you've got a reserve for your taxes and insurance. Is that being taken out of your mortgage already, or are you self-reserving?
I'm paying insurance, and the Hastings City Bank said, no, we want to pull the taxes out. They've got to cover their
so they're
escrowing
your taxes.
Yeah.
Like when is the light at the end of the tunnel? Can you see it?
I can.
Yet?
I can. I need about another year, I think, and I'll be ready to sit back and relax a little bit more. Right now, in theory, I suppose I could lose all 18 water heaters at one time, and that would cause me some stress. Although thinking if I did lose all 18 hot water heaters at the same time, then maybe I can claim an insurance issue.
Yeah, true. So each unit has its own hot water heater.
Yeah, and then one for the house for the washers and dryers.
This has been a great learning experience, just kind of going through your expectations and versus the reality of buying the 16 unit. I want to add my 2 cents to the question of what could you have done differently. And maybe you did this, but when I bought similar properties, old, tired, need some money to go into them, I've been able to find loans that allow me to roll in some of those improvement costs. So you paid $490 for the property. Let's say, let's just use it as an example. You need to put another $50,000 to $100,000 in. There are banks out there or lenders that will roll that into the cost, into the total acquisition price, and loan you 70 to 75% of that amount. Is that something you looked at?
Being very green, I went to, I want to say 3 different banks. Were it a larger property, even then over that $1 million purchase price, I could have gone other routes as well. There was actually a little bit of fear, I think, when Lake Michigan Credit Union said, no, we're not going to do this deal. And I went, okay, so let's go back with the folks at Hastings City Bank that approved me, and they're working for
the community bank.
Yeah, that got the deal pushed through. There was a moment where I'm like, well, if Lake Michigan Credit Union's not willing to do this deal, they're either running their numbers even more conservatively, or maybe I'm missing something.
Well, they're very conservative. I've run deals in front of them, and they're very conservative. So you went with Community Bank, Hastings Community Bank?
Hastings City Bank. Yeah.
Hastings City Bank. So that's great because they're in the community. They have, it's in their best interest to improve the community. Did you ever talk about rolling in the improvement costs?
From the numbers that I saw, I don't think there was a lot of wiggle room. They are more than willing to offer me a HELOC on the property. I've still got that green lighted if I want to pull that money out. I would prefer, I think, to do a second and pull more money out that way.
Lock in the rate.
Yep. So that I'm not dealing with an adjustable rate mortgage because, well, I've already got that in my HELOC.
Sure. So before we move on from your 16 unit, how are things now? Like, what's your perspective on it now? Are you making money? Are you happy with its performance?
Right now, I mean, I think the performance is fantastic. I'm paying for property management because I can't handle it on my own, and teaching and everything else that goes on with having kids and family, and I don't have time to deal with that. So
Now, are you doing any work on the property?
I am. In fact, this summer I did a ton of painting. It had some 1970s, 1960s paint. One side was teal, one side was a beautiful yellow, and now they're a nice gray. But I realized that I wasn't happy with my work because I'm not a painter. I teach science. I do some finance. I'm a property investor. And came home and my son's like, "Why are you painting?" I'm like, "Well, I'm saving a buck. Every dollar I can save is, money that I can use on some sort of capital improvement or something later." And, he's been listening to me, listen to audiobooks and listen to podcasts. And he wisely said, go out and look for the next deal. Find somebody else to paint so that you can keep growing the business.
This is your son telling you this.
Going to be 16 in a couple days.
So what's he listening to, and what books is he reading?
I had him listen to part of the 4-Hour Work Week.
The Tim Ferriss book.
Yep. He's actually going with me now to Texas with the Think Multifamily Group conference the end of next month.
Okay, great.
So he's definitely thinking financially minded. He's thinking about numbers, and he likes math. And I can see that in the future, at least as kind of a side business, he might end up buying and selling notes or doing some investment properties in the future.
Well, that's great that you've got. He's probably self-motivated, but you got him interested in this in the first place. Now, you also talk to your students. You're a high school science teacher, and you're sharing some of this with your students. Let's talk about that a little bit.
I've been teaching about 20 years now, and decided that, why does my personal life need to be so ultra personal? And when students are interested in what they're going to be doing in the future and things that they could be doing in the future, what opportunities they might have, I've just been open and honest, and I gave them all the numbers. They've known really most of my expenses since I started this whole project. And it's not everybody. I mean, we talk, but I've got a student that 2 years ago, when I first started teaching again in Grand Rapids, was day trading on the Robinhood app in class. And I remember, at least in one of the Kiyosaki books, I think that I was reading, one of the stories went, I had this kid that was day trading in class and busted them because they were on their phone and they're not paying attention. And then went, wait a second, I need to talk with this kid. So Jason and I have been talking. He's kind of left the day trading scene a little bit, but now he's trading options and he's doing some stuff in cryptocurrency. And I've been able to talk with quite a few of my different students about investing in the future. And here's what the numbers are. And here's how you can make money passively. They've taught me things. I didn't know really anything about options apart from playing Cash Flow 202 a little bit years ago. And so they're able, it's really kind of a two-way street. I had a student give me one of the Compound Effect book by Darren Hardy, and then texted him this summer and said, golly, is this book going to be so heart-wrenching and making me want to change my ways, the entire book? And he said, yep. I've passed along the 4-Hour Work Week and Rich Dad, Poor Dad, and the 80-20 principles of sales and marketing to various different students. And I'm just thinking, man, if I knew at 16, 17, 18 years old, if I was reading the books that I'm reading now, 20, 25 years ago, good gracious, where could I be when, when I'm starting that young, thinking about finance the way that they're starting to think about finance? It's going to be amazing to watch.
Yeah. So do they get it? Are they understanding it?
Oh yeah. The student that was day trading and doing some cryptocurrency stuff, he's talking about rental properties already, thinking, how could I get into a rental property? I was talking with a student that graduated last year. Dakota is talking about buying a duplex in the future. And house hacking.
House hacking, a great way. Yeah,
You know?
I mean, starting young like that and house hacking with a duplex, no matter how old you are, that's a great idea. I want to go back and talk about the training and the coaching that you've had, because I find that training, and I'm kind of agnostic as to the different training programs and coaching programs that are out there. I mean, my feeling is you get out of it what you put into it, no matter what the program is.
It's exactly what my wife says about education. Yeah.
Yeah. I mean, you're an educator, so
Yeah.
you know. I mean, it's the same. It's like any education, but it is expensive, that type of coaching and training. Since you've done it, I'd like to get your perspective on it, and whether you found it valuable or did you not find it valuable.
I did some research on BiggerPockets and some of the other forums about is Rich Dad coaching a worthwhile investment? And there is a lot of sentiment out there that says, go find a mentor, talk to people in your area. You can get just as good of information or better from somebody local. And I think because they've polished the program, because they have people that you can contact any weekday during business hours, they give you tons of reading material, tons of homework tools that you are supposed to go through. It was worth it. Was it a ton of money? It was about $5,000. Have I wasted other money in my time that I could have spent elsewhere more wisely? Yeah. I think were I to do it again, it was a good plan, starting from somebody that was green, that didn't know anything about real estate apart from reading Rich Dad Poor Dad. And apart from the finance background that I had, the financial aspect was easy. The real estate and all the nuances in real estate, as far as how to make a deal, how to choose and hire an attorney, how to choose and hire a CPA, all the people that you need on your team, and then the push, again, like you said, if somebody's willing to go out there and work for it, to go out and make it happen. I was actually wondering a couple days ago, is the little Facebook group that we started when our group was going through the program, is that still around? And you wonder how many people actually do things. But then, I mean, with the 80-20 rule.
It's 80-20, yeah.
I was one of the few, would be my guess, that actually went out there, found a deal, and made it happen.
So as we wrap it up then, I think you've really done a good job of kind of taking us through your first deal. And there'll be more in your future.
Can't wait.
Yeah, I'm sure of that. But there's a lot of listeners who are, at the beginning or going through what you just went through. What would you say to them? Don't
wait. I would highly recommend networking. I've started going through some multifamily meetup groups. There's a couple guys in Grand Rapids that are absolutely fantastic and teaching me tons of information about syndication and buying larger multifamily. There's people in that group that are waiting to buy, the first duplex, and they want to get more information and more education. And while that's definitely important, you need to have an idea of what you're getting into before you take the leap. Go out there and buy the first property. You're going to have a significantly greater impact on your education when you can go out and buy your first property. Go do it. And you're going to learn more of the ropes and the nuances of buying real estate than just the book knowledge. I sat for, I want to say 10, 15 years reading Rich Dad Poor Dad, thinking it was great. I need to go do this, and just sat on my butt. And when I finally went out and did it, I put my money where my mouth was. Things have changed. Now I've got more opportunities. Now I've got more knowledge. Now I can network more and say, hey, look, I started small with 16 units. Go out and do it.
Fantastic advice. Scott, I want to thank you for taking us through your first deal, your 16 units. It was a real leap of faith for you, I'm sure, a real stepping outside your comfort zone. But you did it. I'm sure it was scary, and you shared some of that with us. But I want to congratulate you on actually getting it done.
Thank you. Looking for the next deal.
Good luck finding that next deal. I give you kudos too for sharing this with your students and offering them mentorship and at the same time learning from them. So it's been a lot of fun talking with you. Thank you for being on the show.
Thank you, Brian.
This episode was sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.